Morning and good afternoon. I am Jonathan McCash, EVP of Wholesale Sales here at Sierra Pacific. I'm excited to have so many of our great partners on this call today to discuss one of the fastest growing products in the mortgage industry today, and that's non-QM. Per a recent report from S&P, non-QM is expected to grow 16% in 2025 and will likely make up 10 to 15% of the mortgage market. You may ask, why is non-QM lending growing in the mortgage space today? Simple answer is QM requirements have left a void in mortgage for borrowers who earn income from alternative means. Per recent data from the Bureau of Labor and Statistics, there's over 10 million people who are self-employed in the United States today, and that number is rising rapidly. Additionally, with rent prices being near record highs, you have investors who see an opportunity to grow their real estate portfolio. Both DSCR and bank statement options will allow borrowers to do that and solve needs for your borrowers. Our call today will help you capitalize on the opportunity with non-QM and working with Sierra Pacific as your trusted lender. We'll teach and guide you through the basics of non-QM and also provides some origination strategies on how best to build your non-QM and referral sources. So before we kick off the call, I'd like to introduce our presenters today. Two of my favorite people here at Sierra Pacific. We have Brina Hertzler, who's one of our account executives in the Northern California market. She's been with Sierra for over 18 years. So welcome, Brina. We also have Suzanne Samid, who is our resident non-QM expert and trainer here at Sierra Pacific. This dynamic duo and two of my favorite people at Sierra Pacific are going to kind of guide us on our non-QM journey today. So before we get into the content, we've got a lot to share and a lot to cover. I want to just talk about some quick housekeeping before we get started. So we have a chat box open here for everybody on the call. Your lines are muted, but there's a chat box open. So we encourage all of you to put questions in the chat box, and we'll answer them as we go. We know non-QM is a product that all of you may not be familiar with, right? And so we want to make sure you enter those questions in the chat, and we'll go through those as we run through our presentation. So again, want to thank everybody for joining the call today and want to hand it off to Brina Hertzler. Brina, off to you.
Good morning, you guys. This is a quick little compliance piece that we put in here that this presentation is what it's for. We can skip over it, but we have to go ahead and put it in the presentation just so you know that anything can change, obviously, because what we're providing is the information this very moment. But as you'll find out that we are going to expand on this, and guides do change. Different investors have different changes. So I just want to make sure that you're aware that if you have a question, obviously reach out to your account executive to make sure that the information is still accurate. Okay, so on to non-QM. This is a really important piece. I had this put into our presentation for a reason. So what is non-QM? We hear that so many times. You get about 50,000 emails between 8:30 a.m. and 9:30 a.m. on non-QM. And I want to just kind of take that, like the mysticism of non-QM away. Non-QM is just an alternative ability to repay. That is it. Like when you think of like what we've done for the majority of our careers, that's more traditional financing. All this is an alternative ability to repay. The two that we're going to talk about today is the very popular DSCR and then alt-doc alternative income sources. So when we think about alternative ability to repay, DSCR is the income from the property, whereas alt-doc is a different income source than we are used to, most commonly bank statements. But we'll go into that and what is provided. The other thing that when you think about non-QM, it's kind of just like this, like, oh yeah, I'll get to non-QM when I get to it, or like it seems like a lot to learn. And this is important for you to know that non-QM is not the future. It is truly the now. Your agents are going to want to know about non-QM. They're going to want you to be a resource for them. And I want to talk about like why this is really important to your agents. It's important because agents want to expand their client options, right? Everybody wants to help as many borrowers in the last several years. And so I'm not going to go line by line on each of these, but you can see that it expands client options. It's going to obviously boost sales potential for them as well as yourself. They're going to stay competitive and be able to enhance client trust and satisfaction by increasing their knowledge of the industry trends, including DSCR and alt documentations. It also can offer like faster transactions. As we know, it went from like 30 to 25 to 21 to 17 to shorter escrows every year. And so market adaptability, as well as faster transactions, is a huge piece to your agents, and non-QM can definitely provide those for them. The first product that we're going to pop into is I'm going to go ahead and walk you through DSCR, and then Suzanne's going to walk you through the alternate documentation. And so with that, we're just going to go ahead and jump into DSCR. Okay, so this is going to be talking about the basics of DSCR. Everything that I'm talking about on this screen, I'm going to go a little bit deeper, and at the end of it, you're going to be like, okay, we get it. But the reason is that some of you have done a couple of DSCR, some of you have never done a DSCR. And so let's just talk. What is a DSCR? So a DSCR is a loan, it's a financing product that assesses the borrower's ability to repay the loan based on the property's cash flow. So specifically, you're going to be taking the ratio of net operating income, that's known as the NOI. Aren't you excited for another acronym in the mortgage lending space? To the debt obligations, and those are the loan payments. So you can see really basic right here. The key metrics is the debt service ratio equals the NOI divided by the debt service. I'm going to hound this in. You don't have to memorize it right this second, but it's very easy. You're basically taking what is coming in divided by what is going out. So then you've got the ratios. You've got a DSCR greater than 1%. This is meaning that the property is generating more income than the debt obligations. Obviously, this is a sign of financial health. You want a 1% typically. DSCR less than 1% means the property does not generate enough income to cover the debt obligations. So who can benefit from DSCRs? We're going to go into like who is going to be your clientele when you're working on this, but it's specifically the clientele is real estate investors. Now, this could be somebody that already owns real estate, or they could be a first-time investor, and we're going to talk about that. But they are looking to finance properties with a consistent cash flow, because again, that consistent cash flow from the property is what we're going to use to qualify them, not their employment income. The property types that we are going to do on a DSCR are going to be anything from a single family residence, a PUD, townhomes, condos. I'm going to pause right here. If you have not worked with our condo department, the condo department at Sierra Pacific is, I'm not joking, you guys, hands down, the best condo department that we have ever had and is the best in the industry. They are unbelievable. So you can do condos with that team on the DSCR, 2 to 4 units, leaseholds, and then properties up to 20 acres. Why are the DSCR loans so attractive? The biggest thing, like I already kind of talked about, is that unlike a traditional loan that we're used to, DSCR loans rely primarily on the property's income rather than the borrower's personal income. This obviously is going to give flexibility to your investors who may not have documentable personal income, but have properties that are generating cash flow. This is a huge reason to know about DSCR, because if you have somebody that has income coming from property that possibly does not qualify with their own personal income, DSCR. The other thing is that the streamlined process allows you to focus more on the property performance versus just the individual. Okay, I told you that I was going to go back through that formula of the NOI divided by the debt service. That is your biggest DSCR formula. So we're going to just jump into it. So that once again, the NOI is what you're going to divide by the debt service to come up with your DSCR ratio. DSCR ratio is king on a DSCR. So again, the NOI is that total income generated by the property after all the operating expenses like your rent income, minus any property managements, any taxes and maintenance. And then the debt service that you're dividing that by is the total annual debt obligations. And this is going to include principal, interest, payments on the loan. In the middle of my screen, you can see 2 examples. When we jump down to the lower part of the screen where it says, what does DSCR tell you? I want to take us there, utilizing those examples to talk it through. So the DSCR that's greater than 1%, this is really what we want. This means that the property generates more income than is required to cover the debt payments. This is a positive cash flow. So when you look in the second example there, you see gross rents at $1,250 divided by 1,000 PITIA equals a DSCR ratio of 1.25. This is that first example of a DSCR greater than a 1% ratio. When I look at the middle DSCR, a 1% ratio, this means that the property's income exactly covers the debt service. So in the first example, you can see that the gross rents of 2,500 divided by the 2,500 interest only equals a DSCR ratio of 1%. So this is a DSCR ratio 1%. And then lastly, you see that the DSCR less than 1% is the property's income is insufficient to cover the total debt service, obviously resulting in a negative cash flow. A lot of times in the market and then those emails that you're getting, you're seeing all these no ratio DSCRs. So I kind of dive into is like, is that really real? Like, is there a no ratio DSCR? And the reality is there isn't a no ratio DSCR. There's just a low ratio DSCR. And so that would follow under that last option there of DSCR less than 1%. All right, so I told you that we were going to talk about your target audience, and you have a couple different types of real estate investors. These are the borrowers that you're going to be helping with this alternative way to process income. They are real estate investors, which are investors who own or are looking to acquire income generating properties. So real estate investors requires 12 months of experience owning and or managing investment properties within the most recent 24 to 36 months. Anytime you see on my screen and in my training that it says 24 to 36 months or 10 to 20 acres, that's because we have a couple different products and there's some flexibility in those, and we're going to go over those, but that's why it looks like that. So when you're looking at a real estate investor, I think sometimes we think this has to be a professional investor. And while it certainly can be someone that's their whole primary employment really is managing properties, it doesn't have to be. It can be someone who has a rental property and is looking to purchase more. So they don't have to have a large portfolio of properties, but that doesn't mean that this is their primary employment of income source. So you've got some flexibility. They just need to have the 12 months of experience. And then secondly, we have first-time investors. It's really exciting that we offer first-time investors to individuals or entities that are new to real estate investing, and they're really seeking a loan to purchase or refinance an investment property using a DSCR loan. I do want to point out that if you have a first-time investor that doesn't have that 12 months of experience, they are allowed on our Sierra Bay DSCR, and there's currently 2 different types of DSCRs, which we're going to go over, but there is some requirements for them. They have to have a 1% ratio. They have to have a minimum FICO. You can see there of 700. The maximum LTV is 75%. And the borrower must currently own their own primary residence for at least 12 months prior to the note date of the subject property, and they must have a current or prior 12-month housing history payment on the primary residence, including a 36-month credit history with a 12-month clean housing payment history. Okay, it's kind of common sense because of what I just said, but I do also want to point out that first-time investors cannot be a first-time home buyer because we just heard that they have to have their own primary residence. These first-time investors, we are very excited for them, but we are limiting to 1 DSCR loan with Sierra Pacific for those first-time investors. This screen that we're going to go through here is really just kind of like everything kind of to know about the DSCR. You can see that the ratio is 1%, which means currently we are not offering a low ratio of less than 1%, meaning we are not offering negative cash flow DSCRs at this current moment. There is more to come that you'll see in the presentation about that, but currently we are 1% DSCR. Again, there's no personal employment or income used to qualify for better or worse. Prepayment penalties will apply. The max LTV is 80%. I do want to let you know that we're going to go over the prepayment penalties because I know a lot of you are like, gosh, I haven't talked about prepayment penalties in a long time, or maybe you're new and you don't even know what a prepayment penalty is. We're going to go over that. The maximum number of financed properties is maximum of 20. There is no AUS. We're going to manually underwrite these with our amazing underwriters. Like all non-owners, there's no gift funds allowed, but there's no requirement for additional reserves for other financed properties, just the subject property reserves only. That is a huge plus. Payment history, like I said, is going to be 0 times 30 times 12, and there's going to be no housing event histories in the last 4 years. The maximum LTV for warrantable condos and 2 to 4 units is going to be capped at 75, and then the DSCR, which we will go into further, is going to be qualified at the original note rate, regardless of ARM or fixed. There is no secondary financing or subordinate liens allowed on this, and like any conventional loan, you can do a maximum 3% interested party contributions on purchase transactions. Okay, I saved the last bullet point for last. Cash back on a DSCR can be used for reserves. I can't tell you how many times as an AE that people are looking for that option. That is a huge plus. We do allow it on DSCR. Okay, so I told you that we were going to go into the 2 different products that we have. The way that I kind of get my mind around these two products is that you've got Sierra Express on the left, that's Sierra Express DSCR, and then you got Sierra Bay DSCR. I like to think of Sierra Express as it's kind of like a smaller box and it goes faster, also known as maybe as more an A paper. And then Sierra Bay is more of expanded guidelines, thinking more of a B paper. You'll see that there is a lot of flexibility on certain guidelines, but that's kind of how I get my mind around it. When you're doing pricing or when you're in the guides, this is kind of how I get my mind around which one is which, really. Okay, so minimum and maximums for each of these products. Express is minimum of 100,000, whereas the Bay is a 125, and then they both have a maximum loan amount of 2 million. The max cash out on both of them is 500,000. However, the max cash out LTV on the Bay, the expanded, is 60%. Unlimited cash out for LTVs less than 60%. Huge plus. Maximum lot size. We talked about that it was the max was 20. So if your borrower has 10 acres or less, they can go on the Sierra Express. However, if they need to go up to that 20% acres, we're going to go with the Sierra Bay. There is a 10% LTV reduction on declining markets for the Express, whereas it's only 5% reduction for declining market on the Sierra Bay. When we talk about solar leases and things like that, it's good to know that on the Solar Express, Sierra Express, there are no leases allowed. There's no UCC filings or any title impediments allowed. Owned solar is acceptable, but we do not allow leased. So if you have leased solar, you're going to go ahead with Sierra Bay DSCR because we do allow leased solar on the Sierra Bay. Okay, interest only minimum credit score on the Express, our A paper, is going to be 700 and reduced maximum LTV by 5% for interest only. Interest only on the Bay is going to be minimum credit score also 700, and the maximum LTV is going to be 75%. Let's talk about non-arm's length transactions. On the Sierra Bay, the more expanded, we do not allow non-arm's length transactions, whereas on Sierra Express, they can be allowed under certain circumstances. So if you have that situation, you're going to have to meet these other guidelines for our little smaller box that goes faster, and you want to talk with your account executive about that. Okay, the other thing that we want to talk about is the difference on the experience of our investor. So on a Sierra Express, we are going to require 12 months of experience owning and or managing investment properties within the most recent 24 months, whereas with Sierra Bay, it requires 12 months of experience owning and or managing investment properties within the most recent 36 months. We also did talk about what would be required for a first-time investor. And so this is really talking about investors in general, people that already own real estate. But we did talk about that Sierra Bay also offers that first-time investor with that tighter criteria for those folks. Prepayment penalties. Okay, so we actually just added what is a prepayment penalty in here because I wanted to make sure that if you were like, oh my gosh, prepayment penalty, what is that? That you know what it is. Okay, so prepayment penalty is a fee charged by a lender if the borrower pays off their loan early before the agreed upon term. So interest rates affect the cost of the loan over time, while prepayment penalties affect the cost of paying the loan off early. One thing to note, just if you're kind of newer, when you're doing a prepayment penalty, you're going to get a better price because of that prepayment penalty. And so when you're looking for a sharper price, you may want to be putting a prepayment penalty, higher in years so that you get a better price. That's how that comes into play. So the following payment structure is kind of what's going to be used. You're going to have the 6 months interest, which this is the prepayment charge will be equal to 6 months of interest on the amount of the prepayment that exceeds 20% of the original principal balance. Totally makes sense, right? The prepayment penalty is applicable regardless of the reason for the prepayment of principal, including prepayments resulting from either the sale or refinance of the subject property and or curtailments that exceed 20% of the original balance in any 12-month period. Okay, when you see the next slide, which I'm not going to go to just yet, you're going to see all the math of how to create this. But I just want to say, like, friend to friend, real estate investors are smart. So if you have a real estate investor that's going to pay off the loan, they're going to likely build in this into their hard cost. And so if you want like a quick tip on how to just pull what this prepayment penalty is, you're going to pull up your amortization schedule. You're going to look at the interest only payments for the first 6 months. You're going to add that interest up, and that is what's going to be your 6 months of prepayment penalty costs. That's kind of like my quick little tip from you to I. But if you look at the next stage or the next slide, this is the math on doing a DSCR prepayment penalty. we're not going to go through this. I'm not going to have you put out your pencil. We're not going to go through a whole exercise for a couple different reasons. Some of you are the math nerd that absolutely wants to like get your paper out and really just grind this out. Some of you want to take my tip that I just used and just go the amortization schedule. And some of you just want to go up into AI and copy and paste. You are you are asked to calculate a prepayment charge, put in your values, and the AI tool will do everything for you. We've already double checked this. So whichever option is your option of preference, those are the options. It doesn't have to be scary. That's what a prepayment penalty is, and that's how you're going to go ahead and calculate it. The other thing to know is that not every state does allow a prepayment penalty, and so the following states do not allow prepayment penalties. Okay, so I told you that we were going to come back into DSCR loans, how they're qualified, lease agreements, and all that. And so that's what we're going to talk about right now. DSCR loans are going to be qualified at the original note rate, regardless of ARM or fixed. So the gross income is going to be calculated using the lower of either the executed lease agreement or the market rent from the applicable appraisal. If executed lease agreement reflects a higher monthly rent than the appraisal, it may be used in the calculation with sufficient evidence of receipt. This would look like 3 most recent consecutive months. For purchase transactions without an existing lease, the market rent from the appraisal may be used. In terms of lease agreements, an unexpired executed lease is required at the time of closing, except for purchase transactions where there is no existing lease or the existing lease is not assigned. So for refinances, a current lease may be supported within 3 most recent bank statements showing those consecutive rental payments. An expired lease agreement that has verbiage that states that the lease agreement becomes a month-to-month lease once the initial lease rental term expires is allowed. Okay, short-term rental income. Do we do it? Yes, we do. We get so many questions on, do we allow the Airbnb income? So it is eligible. When I talked about those 2 different products, I had that little box, Sierra Express, and I had Sierra Bay, which is more expanded. Short-term rental income is eligible on Sierra Bay DSCR for both purchases and refinances. Short-term rental income is only allowed on the Sierra Express, the fast, more A paper, for refinance transactions. So let's talk about that. The gross rent is going to be determined by the lower of the market rent disclosed either on the appraisal or the 12-month short-term rental history. Short-term rental history will be verified from a third-party property management provider, which we're going to get into, and obviously it has to contain property address, ID specific. Okay. Short-term rental income. This is what I said we were going to break down a little bit more. I already told you that it's acceptable, but it must be verified by a third-party property management provider. So if you're wondering, like, can this be Airbnb, VRBO, HomeAway? Absolutely. It does need to be, the information does have to contain the property address and, like I said, the ID specific to that subject property. But here is going to be the criteria for utilizing that short-term rental income on the Sierra Bay. The max LTV on these is 70% with a minimum 1% DSCR. Again, the 1% means that what is coming in is equal to what is coming out. So there's not like a large positive, but there's definitely not a negative cash flow. This is going to be permitted for both purchases and refinances. If you have a new construction short-term rental income, that is allowed, but it must be deemed common and typical for the area per the appraiser and the property location. Gross rents are going to be determined by the lower, again, of the market rent disclosed on the appraisal or the 12-month short-term rental history. 12 months is required for refinance only, obviously. Property may be vacant if the property has been staged for a short-term rental. You know, you see these short-term rentals, they're already staged. The appraiser is going to comment on that, obviously with photos, and note that it's already staged, which allows us to know that although it's vacant, it is a short-term rental history. I mean, it's a short-term rental income property. And then lastly, I kind of just wanted to go through, you know, like a product and pricing comparison, because of a lot of times we're kind of like, well, why would I do a DSCR over just a standard conventional non-owner? And so this is just a quick little scenario. You have a DSCR ratio of 1.3. Obviously, a non-owner doesn't have a ratio. You've got a 3-year payment penalty. Obviously, a non-owner doesn't have a prepayment penalty. It's only allowed on DSCR. I put in a 760 credit score, purchase, single family, non-owner. And you can see here that when you're in your pricing engines, they're typically around the same price as a non-owner. However, there is some flexibility again when you're looking at the difference between just a conventional non-owner and a DSCR. And I kind of just wanted to highlight the top 3 of these, aside from obviously the difference between employment income and property income. So if you have proof, if you have a condition that says proof of PITI for all properties owned, on a DSCR, the underwriter is not going to give you that condition. On a conventional non-owner, you are going to get that condition. Tax returns, if other REO was acquired in 223 or before, an underwriter is not going to give you that condition on DSCR. However, they are going to give it to you on a Fannie Mae non-owner. And then negative cash flow is going to be affecting the REO and impacting the DTI. The negative cash flow of other REOs for that borrower is not going to impact the DTI on a DSCR, where we know that the overall picture is looked at on a conventional non-owner. This is going to be kind of you're going to be able to look at the difference between a non-owner and a DSCR based on who your client is and where their strengths are, and compare the two. But I just wanted to point out that often the pricing is very similar. And so you're able to go with a DSCR that might be more beneficial to your client's specific needs. Okay, how do you guys feel? That wraps up our DSCR. With that, I'm going to go ahead and pass it off to Suzanne Samiz, who's going to go into the alternative documentation for different types of loans.
Awesome. Thank you, Brina.
You're
And can I tell you how hard it is to go after Brina? So like next time, I'm going to go first. You go second. Okay. No. All right, so we're going to jam through the alt doc programs that we currently offer. I also have some coming soon slides to show you guys some stuff that Sierra Pacific is currently working on. And then a little bit of bribery never hurts. I also have gift cards to hand out at the end. So I'm going to have a few questions at the end. So go ahead and start paying attention now. I know we're in California and it's still a little bit early, but we're peppy, so you guys can be too. All right, let's dig in. Okay, so Brina had gone over your selling points for DSCR, so I'm just going to go over your selling points for your alt doc. So alt doc is for alternative documentation. So that means instead of giving tax returns, we're going to look at bank statements, 1099s. We can even look at a P&L. So again, it's flexible documentation. This is ideal for the self-employed borrower who writes everything under the sun off. Faster processing, so less paperwork, typically means a faster process. Again, no need for those pesky tax returns. And then it's the easier qualification, right? Here is our alt doc summary. So this is a summary of the 3 products that Sierra Pacific currently offers. So I'll just kind of jam through these. It is a full manual underwrite, but we are required to run DU for your automated underwriting decision. And then we do need to have those findings in the file. Just know that unfortunately there's no documentation relief as a result of those findings. We are required to provide the complete documentation per the guidelines for the specific alt doc program you're using. Inclusion of tax returns and tax transcripts will render the loan ineligible. So if you've got those in your loan file, go ahead and take those out before you go ahead and submit to Sierra. Your minimum credit score is going to be 660. Your maximum DTI is 50 to 55. The 55 product does have a few little extra requirements, so we'll go over those in further detail shortly. Maximum LTV is going to be 90% with these. Your eligible transaction types are purchases, rate and term refis, and even the good old cash out refi, everybody's favorite right now. Occupancy is going to be for primary, second, and investment. And then your eligible property types are going to be 1 to 4 units, PUDs, townhomes, warrantable condos. We even have a lane for unwarrantable condos. Your terms are going to be a 15 and a 30-year fixed, as well as some ARM options. Our loan amounts, similar to DSCR, are going to range from $100,000 to $2 million. Borrower minimum contribution is going to be 5% with an LTV greater than 80. Bank statements, 1099, and P&L income may be combined with additional supplemental income sources. Just note that that income has to be separately documented on the 1003. Some examples of that supplemental income might be your spouse's wages, retirement income, Social Security. We even have information on how to document rental income since you are not able to include your tax returns. So we'd be happy to send that out with the presentation if there's a need for it. Reserves are going to be 3 to 6 months, depending on your product. And then just note that a collateral desktop analysis is required on loans with 1 appraisal. So if your loan has 2 appraisals, that's not necessary. Unfortunately, no asset validation reports are allowed. We're real big on phonicity and validation here at Sierra Pacific. So this one personally broke my heart. Hopefully we'll talk an investor into it soon. Credit refresh required within 10 days of closing. This is a big deal. So we all tell our borrowers, don't go get that new auto loan. Don't go shopping for furniture. Same thing with this. So if you're closing within 10 days, no new auto loans, and please don't sign the lease for the kid. The kid's probably been stuck in your house for 30 years. What's another 30 days going to do to you guys, right? Mortgage and rental payment verification is required, and it's going to be a 12-month history with no 30-day lates. And then here's a quick breakdown of the 3 products that we currently offer. So as Brina had mentioned, we have the Sierra Express, which is more of your kind of A paper. And then we have the Sierra Bay Alt Doc A and the Sierra Bay Alt Doc. I think they might call it one. I differentiate them by investor. So we've got Sharp A and Expanded Prime. We're working on the naming conventions. We had this discussion yesterday. So we'll make sure we get these a little bit clearer for you guys to differentiate. With your Sierra Express, your minimum loan amount's $100,000, whereas with the Sierra Bay, it's $150,000. We're capped at $2 million for all 3. Maximum cash out's $500,000 for the Sierra Express, and then your maximum cash out with the Sierra Bay is going to be based on your LTV. We now offer all 3 options with all 3 products. So you could do bank statements, 1099s, and P&L statements. Your non-warrantable condos aren't going to fit in the Sierra Express, but we can do them under the Sierra Bay product. So just note that there's the maximum LTV requirements between the 2. Your maximum DTI is going to be at 50 for the Express, and then at 50 for the Sharp A. We can go up to 55 with the Expanded Prime. And then with your terms, we've got your basic 30-year for the Express, and then we've got an addition to your 30-year of a 15-year for your Sierra Bay. And then reserves are required. So Sierra Express, you're looking at 6 months. You're also looking at 6 months for the Expanded Prime, and then only 3 months for your Sierra Bay Alt Doc A. And then the next 3 slides, I kind of just dive into each product. I just want to tell you, as Brina had mentioned at the top of the hour, this information changes often. I have been working on these slides every single day for a couple of months with updates. And honestly, it feels like there's probably an update every day. So always be sure to reach out to your AE, get updated information, because just because it doesn't fit today doesn't mean it's not going to fit tomorrow. So with the Sierra Express, so we're looking at 12 or 24 months personal or business bank statements, and then 1 to 2 year 1099. This one again capped at 50% DTI, 80% LTV. Maximum cash out again is $500. First time home buyer is allowed. We do have to see their rental housing history, and it has to be 0 30-day lates within the most recent 12 months. Unfortunately, borrowers who lived rent-free cannot document a 12-month history, and they would not be eligible. So a good conversation to have with your borrowers up front. Maybe if they don't have the rental history right now, maybe we could get them into a position where they'd be able to document that and set them up for a future loan. Non-permanent residents are going to be capped at 75% LTV. Rural properties, so it has to be owner occupied or a second home only, so no investments. We're capped at 75. The property cannot be income producing, and it must be residential as highest and best use. We're capped at 20 acres for this property as well with the Express. And then declining markets have a 10% LTV reduction. Let's all hope we don't have any declining markets. So far, so good. 2 to 4 units are going to be capped at 80%, and then your non-warrantable condos not allowed with the Express, and then unfortunately no manufactured homes. Real quick, do we have any questions, Will or Ashley, that we should address?
No, they're all good and caught up.
Awesome, you guys are fantastic. Okay, so next one is this.
Suzanne, I was also going to remind them that we are creating a matrix. Because Suzanne's going through all this, and I'm sure you guys are like, whoa, but we are creating a matrix that will make it very easy to have this information confined into little boxes so you can just grid it. So I just wanted to point that out.
yeah, we're waiting for one more product to roll out, and then we'll be doing a matrix, and then we'll send that out to you guys. Marketing team's working on it, our credit risk team's working on it. So yes, we will get you guys all kinds of good tools, because even I have to go back and figure out which guideline allows for this and go back and forth. So you guys want to see that easily, and we totally get that. Thank you for bringing that up, Brina. I appreciate it. All right, expanded prime. So this one requires 48 months seasoning after a derogatory housing event. So that's going to be your foreclosure, short sale, deed in lieu. Again, that mortgage history, no 30-day lates in the most recent 12. Here's where I was talking about where you could go up to 55% DTI. Your requirements for that are going to be the 700 FICO. You're going to be capped at 80% LTV. It's for a primary residence only. Can't be a first-time home buyer. And then it requires 1.5 times of residual income. 12-month P&L is going to be limited to a max of 80% LTV, and that carries a minimum FICO of a 660. There are 6 months minimum reserves. For a first-time home buyer, they can't have a payment shock of over 250%. Rent-free first-time home buyers are unable to meet this payment shock requirement. Must again have the 0 30-day lates in the most recent 12 months. Max DTI for the first-time home buyers 50, and then this is eligible for primary and second homes. Non-perm resident, also primary and second homes, and capped at 80. And then rural properties, again, has to be owner occupied or a second home, and it's for purchase and rate term refis only, so no cash outs, unfortunately. Max at 75% for that one. Declining markets and a rural or second home is going to be a 5% LTV reduction. 2 to 4 units are capped at 85. You can do warrantable condos to 85. Non-warrantable condos are allowed under this product, and they are capped at 80%. And then again, no manufactured homes. Okay, I'll run down one more, and then I promise we'll make it exciting. So the Sierra Bay, the Sharp A, this has a little bit more flexibility to it. So you're looking at 36 months seasoning required after a derogatory housing event. So it's foreclosure, short sale, deed in lieu, blah, blah, blah. Mortgage history, you can have 1 30-day late in the most recent 12. Max DTI is 50. With your 12-month P&L, we're going to be capped at 75. Non-perm residents are going to be capped at 80% LTV, and we could do this for a primary and second home. First-time home buyers, again, you've got that maximum payment shock of the 250. Again, rental payment history needs to be 0 30-day lates in the most recent 12. Max DTI is 50, and then it's owner occupied and second home only. Again, for your rural properties, owner occupied, second home, purchase, rate and term, no cash outs. I don't know why the investor hates cash outs on a rural property. Declining markets, you're going to see a 5% LTV reduction, 2 to 4 unit, max of 80, warrantable condo, max of 80, non-warrantable condo, again, capped at 75, and then again, no manufactured homes. Next thing I want to go over with you guys is I too am an underwriter. I've been in sales, I've done underwriting, all kinds of fun stuff. And something that we've discussed at length is the business narrative. So you guys will hear this a lot. And if you want to score points with your underwriter or your scenario desk, we highly advise that this is provided upfront, even when you're just running your bank statements for an income for a scenario. So why is the business narrative so important? It tells us what type of business the borrower runs. It tells us if the borrower actually creates a product or if they resell a product, what those costs associated with that might be. Tells us how many employees they have and what their payroll expenses look like, what costs are associated with the borrower's business, and then how does the borrower find their customer. These are all items that we need in order to determine the usable income. So again, when you're sending in those bank statements to our scenario desk and asking for us to calculate that income, we really need this business narrative. We need to know what the borrower's ownership is in the business. We need to know what their expense ratio is so that we can give you an accurate and true reflection of what your income is. There's nothing worse than sending your income into a scenario desk and they're like, hey, you can use all of this. And then what do you know? A few weeks later, you get it to underwriting. Underwriter's like, no, you can't do it because this, and this. So we don't want you guys to experience that. So if you take anything away from my portion of this training, let it be that we need that business narrative. Okay. And then I went ahead and included a screenshot of how to find it. So it's in our all regs with Sierra Pacific. And then you're going to go to Jumbo Loans Non-QM. and then you hop over here to forms, click this beautiful link for your bank statement worksheet, and then it does have a few tabs on it. So just note that when you first pull it up, it's going to have your calculator for your income. Your middle tab is your business narrative, and then the next one is our deposit analysis. Okay, and then next, I'm just going to go through a few Q&A that I had with some of our other loan officers in previous trainings. So we'll go through this, and then I'm just going to show you real quick what's coming, the most exciting part, and then we'll open it up from some additional Q&A. So I asked this loan officer, what's your approach when discussing investment properties and the difference in process between a conventional loan and, say, a DSCR loan? He said it's much easier, it's less documentation, less conditions, less headaches, right? Less emails, less drama, as I like to call it. The other thing Brina had mentioned is the rate. So to have your pricing be so similar to a conventional product is unheard of. So we've got great margins with non-QM. So please take a look at that. You may be looking at a borrower doing a non-owner occupied property. I want you to think of DSCR first. I also asked him, do you mention DSCR products with borrowers who are just closing their first loan? So maybe we just did their first purchase, FHA loan. Do we plant the seed for DSCR for future investment opportunities? This is a top LO. And he said, yeah, of course. We can help first-time investors under the Sierra Bay product. And if they have, or once they have 12 months of their primary payment under their belt, they can look at future investment opportunities. Another plug is he brought up we can use our fast track HELOC for funds, and he's totally right. So anyone that's not familiar, we do have a Sierra Pacific fast track HELOC. It's very, very quick when it works. It's beautiful. So something else you guys can look into. I asked him, is there anything that surprised you when you started doing a lot of these? He became very successful, and I wanted to know what's the secret sauce. He said he didn't realize that a single family residence or like a PUD was allowed. He was thinking it had to be an investor. It had to be someone who had like a portfolio properties or multi-unit properties. It doesn't have to be. It could be someone who has a single family residence and just wants to buy an investment property. I did ask him how you handle the conversation of prepayment penalties. So anybody that's been in the business long enough, we remember 2008 and remember prepayment penalties played a role. So I get a little bit of a nervous twitch when I hear this, but it's nothing to be scared of. So he said the way he handles it is, of course, there's several states that don't allow them. So we want to make sure we check our guides first. He was finding that the 3-year prepayment penalty was the sweet spot for pricing. It's also a reasonable amount of time for the borrower / investor to sort out how they want to manage that property, right? Higher prepay, you're going to have some better pricing. So it's definitely worth a conversation with your borrower to figure out what their overall plans for the property are. I also asked about his pre-approval process, and I thought this was genius. You guys are probably doing the same, but if not, here's a tip. He's pulling a soft credit report, so they're not getting trigger calls from other lenders, huge. And then he was getting them pre-approved as a second home, and then he would flip it to a DSCR loan once the property was located. So I thought that that was something very important to share. And then hot off the presses, are you required to have a license in the state that you're doing a DSCR loan? And there are currently 42 states that do not require a license. Yay! I did go ahead and spell out the 8 states that do require a license. So that's going to be Florida, Georgia, Nevada, South Dakota, Oregon, Idaho, Utah, and then unfortunately, Ohio is not eligible for DSCR at that time. Again, come back and check. We're still looking into a lot of these things to see if we can expand this into further markets. All right, here's the good stuff. Okay, coming soon for DSCR and AltDoc. So we have a Sierra Plus DSCR in the works. This one is going to be priced very aggressively. So you'll see that the DSCR ratio is 1.15. We have a minimum of a 720 FICO, 30-year term, 100,000 minimum loan amount, 1.5 for your maximum. For your maximum LTV, it's going to be based on your actual loan amount and then your transaction type. So you'll see for a purchase rate and term refi, that's going to be capped at 80%, whereas if you're doing a cash out, we're going to see that 5% dip in your LTV, so we're capped at 75 there. No limit on maximum number of properties owned, so this is a big one. I did just want to note, again, underwriting brain, the SPM will not finance a condo where the borrower owns more than 1 unit in the same condo project. Your eligible property types are your typical SFR, attached, detached, PUDs, 2 to 4 unit, and warrantable condos. Again, unfortunately, no manufactured homes, no rural properties over 3 acres, and then no non-warrantable condos. Again, that payment history, no 30-day lates in the most recent 12. First-time investors are allowed on this one too, so you'll have a maximum LTV, and that's going to be reduced by 5%. So with your basic matrix, we'll drop that by the 5%. Cash out is also going to be reduced by 5%. And then there's a minimum reserve requirement of 8 months. Another huge win, cryptocurrency is allowed. So our other products, it wasn't. I was super stoked when I saw the proposed guides for this one. And then I did want to note your short-term rental income is going to be allowed on refinances with this. And then an experienced investor is going to be defined as a borrower who owns 1 or more non-owner occupied investment properties for at least 12 months within the most recent 36-month period. Okay, and then everybody's favorite is the Sierra Bay expansion. So we heard you loud and clear. We've all been screaming it from the rooftops here at Sierra as well, and they've listened. So we are now working on expanding the Sierra Bay to go down to a ratio of 0.75 to 1. This is the proposed matrix. I did have to throw my little legal disclaimer at the bottom that this is subject to change. It's not final. These changes are expected to roll out within the next 30 to 60 days, hopefully sooner, but it is dependent on some external sources and vendors. And then lastly, I have our Sierra Plus Alt Doc. This one also exciting. Minimum 660 FICO. We've got a 30-year term and then a 30-year with a 2-1 buy-down. 100,000 is your minimum loan amount, and we'll go to 2.5 for investment. And then this is huge, 3 million for primary and secondary homes. Again, no limit on maximum number of properties owned. DTI's 50 on this one. Eligible property types are going to be the same. Again, unfortunately, no manufactured homes, no rural properties over 3 acres. We can't do non-warrantable condos with this one. I did want to note that the non-occupant co-borrower is only allowed on purchase and rate and term, so not eligible for a cash out. You guys already know that payment history. We've drilled it in. And again, you've got a first-time home buyer is allowed. So minimum 660, max loan amount 2 million. All occupancy types are allowed. Subject rents from the subject property transaction would not be allowed. And then your maximum DTI is 50. So if it's greater than 40%, there's a 300% payment shock. I did go ahead and give you guys kind of the payment shock definition. Some people aren't familiar with that these days. So I broke this out for you. And of course, we will be sending this to you to refer back to. Maximum loan amount is going to be 2 million. And then if you've got one borrower who's a first-time home buyer and the other one isn't, you don't have to follow those guidelines. You could follow the standard. And then again, huge win. So excited. Cryptocurrency is allowed, and then asset depletion is allowed. I can't tell you how many questions I get from our scenario desk of, can we just use asset depletion or asset dissipation like the good old days? And guess what? We can with this one. So super excited to see these things roll out. And before I hand it back to Brina, I just want to check, are there any Q&A questions? Anything we have, Will or Ashley, that we need to go over?
No, everything looks good. Just to clarify, the bank statement program, the alt doc, it can go down to a minimum of a 10% expense factor with the CPA letter provided, as long as it makes sense.
Fantastic. Thank you, Ashley.
Yeah, thank you so much, Suzanne. That was so good and so informative. And I know it's a lot of guides to go over, which is why it'll be really exciting once we get those Sierra Plus products. Just as a reminder, Sierra Plus is going to be the most aggressive pricing. And so when you see Sierra Plus DSCR, you know that's only for DSCR, and Sierra Bay Alt Doc is going to be for the alt documentation similar to bank statements. But I know that when you see all those product codes, it kind of becomes a lot. All right, so as I close, I just want to talk of one of the benefits of Sierra Pacific really being all in on non-QM products. Because you've seen, we've really put a lot of effort into enhancing our guides. We brought on some really great non-QM talent. And one of the benefits is that you already love working with Sierra Pacific. We see that all the time in the feedback and our reviews and the text messages that AEs receive when the loan closes. and you love really like our all hands on deck approach with our operations staff and how fast they are. You love being able to talk directly to your underwriter, and that's going to be really important on these type of loans. You love how easy our broker platform Express Loan is. You love your AE because they're a master at their craft and they're able to help get you a yes, and then Sierra is able to execute on that yes quickly. And so now you really have an opportunity to work with us more and to be able to offer a solution to some of your borrowers that need to be addressed with their income in a more unique way. And so this is really exciting. Like I said in the beginning, this is not like a little side thing. This is not the future. We are bringing this now. We are all in, and we're really excited to be able to walk you through. We hope this training kind of help formulate some of like what the myths are and what some of these terms really mean. Obviously, like I said, your account executives are all on this call. They thought it would be really important for you to be on here. Reach out to them, build relationships with them as you start to do these loans. They are the best in the business. And we're really looking forward to having a wonderful year with you in 2025. Thanks so much for coming.
Thanks, guys. Have a great day. Bye.